In this video, I'll show you how to trade crypto on Blofin. I'll explain exactly what crypto futures are, how to trade them, and then some live examples as well. If you're new to Blofin, I'll leave the sign up link down below. They always give some sort of bonus or offer for new users, but it does change over time. So if you want to click that link, you can find exactly what the offer is at the time you're watching this video. And then we'll go through trading USDT margin futures and then coin margin futures as well. What's the difference and what should we trade? If you want to know how to get set up on Blofin, I'll leave a beginner's tutorial for the platform down below in the description, which shows you how to set up an account and get crypto in and out so you can start trading. I'll leave it for that video and just focus on trading for now though. So we want to go into futures and then we're going to look at USDT margin futures right now. So futures are different to spot trading. Spot trading, you just put some cash on the exchange, you buy your crypto, that's yours, you can withdraw it. Or you can keep it on the platform or do whatever you want, but that's your property. With futures, the only thing we're doing is trading the price of the assets. We're not actually trading the asset at all. This is a completely different market, and it's essentially just trading paper back and forth. So we open a position at a certain price, and then we close at another price. If that position is a profit for us, the profit comes to our account. If it's a loss, we have to pay out the loss. So with futures, you open and close positions and you either win or lose, so you make a profit or a loss. The only thing we need to do in a futures account is essentially put some cash in the account to pay for potential losses. Once we've done that, we can go ahead and trade. So this is how it works. You put some sort of collateral in the account to trade with. That will have a dollar value that you can use to open positions. From there, you can open a trade with or without leverage. Leverage is allowing you to trade with a dollar value that is more than the dollar value of your collateral. You can do that because you have cash there to pay for potential losses. If you don't want to use any leverage, just choose 1x leverage, which means you have $1,000, you open a $1,000 position, no problem. You can, of course, use higher leverage. You can use 2x leverage, for example. That means if you have $1,000 on the platform, you can open a position worth $2,000. That's 2x leverage, right? The reason they will let you do that is because you have $1,000 of cash there to pay for a potential loss. And as long as you can pay for the potential loss, you can open the position. Now, using leverage increases each percentage move by the amount of the leverage. So if you're using 2x leverage and the price moves 1%, that's actually like a 2% move in relation to your underlying capital, right? Because now you're trading with 2x the amount of cash versus what you could just by trading without leverage. It makes wins more and losses more. So you can work out how much leverage you want to take, and I'll go through that in this video. But essentially, if you're taking 2x leverage, you can open a $2,000 trade, but a 10% loss, instead of being $100 on your 1,000, it's now $200. If you're using 5x leverage, a 10% loss turns into $500, which is like 50% of your original capital. If you have 10x leverage, you can see here, and you make a 10% loss on that trade, that's like 100% of your original capital and you get liquidated. You have $1,000 in cash, you make a $1,000 loss. The exchange is going to get you out of that position, take your cash, pay the loss, and remove the trading position. So I'll explain leverage and if you want to use it and how to use it throughout this video. You don't have to use it if you don't want to, but we can, and we can increase profits and losses with leverage if you want to use it. Most people use stablecoin margin futures. So we have to put some value on the platform to go ahead and open trades, and that cash is there to pay for potential losses. Most people will put either USDT or USDC as their margin on the platform. So you have 1,000 USDT, it's $1,000, right? Because it's a dollar stable coin, or $1,000 worth of USDC. You have that collateral there, it's $1,000. You know exactly how much cash you have to pay for potential losses. So that's what most people trade with. This is known as USD margined. So you can see that here, which is USDT and USDCM, which means margined. Margin is the cash that you have to pay for the positions. Now, Blofin also recently added coin margined futures. So you can see here, this is coin M or coin margined. That means that you're actually using the crypto asset to margin the positions. So let's say I have $1,000 worth of Bitcoin. I can put the Bitcoin on the platform, and now I'm using the dollar value of the Bitcoin to margin my positions. This is very different. US dollar margined is less volatile because the $1,000 is $1,000. Everything when you trade futures is cash settled, meaning you are just making profits and losses in dollars. So you've got $1,000 in cash there. You know exactly how much the price can fall before you get liquidated, or if the price goes up, you know exactly how much you're making. With coin margined, you're using the dollar value of crypto assets. So you put $1,000 of Bitcoin on the platform. Well, each and every second, Bitcoin moves in price in dollar terms, right? So your collateral, you put $1,000 on there, that can change. So let's say you take a long position with coin margin futures. You're using Bitcoin to margin a Bitcoin long. Now, this is extra volatile. And actually with coin margined, you make or lose, so you make your profits or losses in the coin itself instead of dollars. This increases volatility. So let's say you have $1,000 of Bitcoin, you're long Bitcoin, and Bitcoin moves up 10%. Well, your trading position is winning by 10%, but your collateral is also going up in price. And so when you use coin margined, you get this kind of exponential gain or loss in your trading position. If you're long with coin margined, you make much bigger gains because the collateral and the trading position move up together. On the flip side, making losses is extremely volatile as well, because if you have Bitcoin there and you're long, the price moves down, not only is your trading position losing, but your collateral is actually losing value as well. And so you get wiped out much quicker to the downside. So coin margined is for the brave only, and it's extra volatile. In bull markets, great, as it's moving up. In bear markets and you're long, not so much. So most people do trade with US dollar margin futures, as they know their collateral there is going to stay the same, and it makes it a little bit easier and safer to work out the positions that you want to take. Before opening any positions, we can choose exactly how we margin those positions. So we margin a position, we put the cash there to actually open the position to pay for potential losses. On the right hand side, you can see these two icons, cross, which is the way that we margin, and then 2x, which is the amount of leverage that we're taking on that margin. So let's first look at cross. We can choose between cross and isolated. Isolated margin is where individual positions are restricted by the amount of margin allocated to each. So let's say you have a Bitcoin position and an ETH position. With isolated margin, you put $500 into your Bitcoin position, $500 into your ETH position, and they move around. Now, let's say the Bitcoin position loses. Well, that $500 is going to get wiped out, but because it's isolated, it doesn't affect our ETH position at all. So that got wiped out, but our ETH position is fine because the margin, the cash that we're putting in, is isolated in each position. With cross uses the cash in your account on all of your positions at the same time. So you have a Bitcoin position and an ETH position. Let's say Bitcoin moves down and ETH moves up. Well, you're not going to get liquidated in your Bitcoin position because you're cross-margining your assets. Because the ETH trade went up in value, you actually create equity in your account because that trading position, if sold immediately, has a value, right? So you have equity from your ETH position, and that is actually going to pay for the Bitcoin position because you're using cross margin. So as long as you have enough margin in your account using cross, you can have wins and losses. This increases potential risk because one trade, especially if you're using high margin on that one trade, if it really goes south and you lose a lot of money on it, it can drag all of your other positions and drag all of the equity and margin you're using in those other positions as well. So cross margin is a little bit more advanced. There are some advantages to using it across different positions, but if you're just starting out, maybe use isolated and see how each position works, especially if you've got a bunch of different trading positions. So you've got a bunch of core positions where you're using a little bit lower leverage. Maybe you want to trade some higher leverage positions and a bit more risky. You want to isolate those, right? Because you don't want them to affect your other core positions. So it's up to you and how you want to trade. It doesn't really matter. I'll just show you cross margin for this example. The next thing we have to choose is how much leverage that we take. Leverage is the position size in relation to how much cash you have down. So if I've got a 2x leverage position, that means my position size is 2x my cash. So another way of saying that is that I have to fund half of the position. So we can choose this. 1x is no leverage. This is 2x leverage, 3, 5, 10, right? So let's do 2x leverage and press confirm. What that means is my position size that I can open is 2x my collateral value that I have to put down. So let's open an order here, and let's choose a US dollar amount. That makes it easier, so we can confirm how many dollars that we actually want to trade. Let's do $100. Now down here, you can see that the cost is, let's say, $50. Why is that? I'm using 2x leverage. So $100 trade size is 2x leveraged on my cash. $50 I have to put down. 50 times 2 is 100. Let's go and increase the leverage to 5x. Press confirm. You'll notice now that my position size hasn't changed. That's what I want to trade with the market. I'm telling the trading system, this is how much I'm trading, and that's the position size. But you should see the cost now is lower, right? It's, let's say, $20, which is a fifth of 100, because I'm using 5x leverage. So my cost is $20 times 5x leverage is the $100 trade size. If we use 10x leverage, then obviously 10 times 10 is 100. So you should see that my cost now is $10. So the leverage doesn't change the position size. You tell the system the position size that you want to trade. The leverage is just simply a multiple of the cash that you put down. That also means that the higher leverage that we use, the less volatility to the downside that we can fund. If I'm using 10x leverage, and my $100 position can move $10, I can fund $10 as a loss, right? 10% of 100 is $10. That is what I can fund from a 10x leverage position, a 10% loss. 10% of that $100 position, $10, that's what I can fund. If we get down to 10+%, I have no cash to fund that loss anymore, I'll get liquidated. If I'm using 2x leverage, I can fund 50% of the position, so I can fund a 50% loss. That is what I can fund around here. So if it's $100,000, I can basically fund it down all the way to $50,000. Right, so I'm using 2x leverage, I'm funding more of the position. How much leverage should you use? Personally, I think very low leverage, but it's up to the individual. Look, if you're trading a very volatile asset with 10x leverage, a 10% move to the downside can wipe you out, which is almost certain. If you're using maybe 5x leverage, 4, 3, right, you're able to withstand a much more volatile move to the downside. That's up to you and your analysis of where you think the price will go and your own technical analysis. Using leverage can increase risk if you're just using very high leverage. So if you're using 20x leverage, right, a very small move to the downside is going to completely wipe you out. However, if you're doing technical analysis yourself, let's say that you can see that this area right here, so we'll use the rectangle, this area right here seems to be a support and resistance zone, and you're fine with the price coming down here, taking a risky position, right? And so this area here, you say, you know what, I'm going to trade long. I'm willing for the price to go down into this support and resistance zone. However, if we get down to this level, let's say that that's probably a little bit low and we want to get out. So we can withstand a 25% loss. Well, that means that I can essentially use 3x leverage without increasing the risk in my position. If I stop myself out, and I'll show you how to do that, if I stop myself out at a 25% loss, then I can use 3x leverage, because a 3x leverage trade can withstand a 33% loss. That means that I'm not increasing any risk in my own position anyway by using 3x leverage versus 2x leverage, because I'll get out of the position at a small loss myself first. So using 3x leverage is totally fine, and it will not increase the risk of my trade. That means that I can put less cash down into the trade, which means I have more cash for other positions, or maybe just keeping off the platform in our wallet so we know it's safe, right? So if you know that you're getting out of a position at a certain price, you can use leverage up to that level and it's not going to increase the risk of your trade. However, if I were to use 10x leverage now, and I think that the price can move 25% to the downside, I'm going to get liquidated by the platform up here in a 10% move, which means I've increased risk and I'm liquidating myself before my own stop loss, which of course is way too much leverage. It means you don't have enough cash to fund the downside volatility that you think may happen. So that's how to use it a little bit more professionally, saying what's my own stop loss level, where do I want to get out for that trade, and how much volatility can I stand? And then you can work out how much leverage you can use without increasing your risk, which means you put less cash down in the trade, you have more cash outside of the platform or doing other things. When we trade crypto futures and have open positions, we always have to keep an eye on the funding rate. Funding is something that happens in the futures market because we're trading a synthetic product here. It's just trading the price. This isn't the real asset. And so that means that this price is a different market than the actual underlying pair that we're trading, which is Bitcoin USD, right? Bitcoin USDT. So this price is different, therefore it can change versus the underlying pair. Now, if this price here is wildly different from the underlying pair, it becomes untradeable because you don't know what the price is going to be, right? It's unreliable. So how does the exchange, or how does every exchange, keep this price in line with what the actual price of Bitcoin is against USDT? They use this funding rate. Think of funding as an incentive or a bonus to keep the market here in line with the underlying. So if this market is full of buyers pushing the price up too high in relation to the underlying, those buyers are going to have to pay a fee to do that. It's a disincentive to say, look, you're pushing the price up too high. You shouldn't do this. So we're going to make you pay a fee. And that fee gets paid to the other side, which is sellers. So they get an incentive to say, hey, look, the price is too high. Come in and sell and get this fee from the buyers. The other side of that is that if this price is too low in relation to the underlying, then too many sellers are coming in. Those sellers will have to pay a fee for doing that, and buyers will get incentivized and receive that fee. If the funding is positive, buyers pay. If the funding is negative, sellers pay. But ultimately, they just want to keep it in this range, exactly the same as the spot price. Sometimes you may pay this, sometimes you may receive it. In bull markets, mostly the funding is going to be positive. In bear markets, you might see it quite weak and negative. We don't really know, right? So for the most part, just make sure that you have some cash in your account to pay for funding. Funding gets exchanged every few hours or so, and it's a small payment. But if you're long and funding is positive, you are going to have to pay out a small amount to the other side. So factor that in. During massive bull markets where funding is very high, this can add up to quite a lot. Usually, especially with bigger tokens, it's probably going to be in the region of 5-10% on a yearly annual basis, so not a massive deal, but something you need to be aware of and have some cash in your account to pay for potential funding rates. Now I'll show you how to open a long position. So we need to transfer some assets into our futures trading account. If you need to know how to deposit crypto into Blofin and everything else, I'll leave that for the beginner's guide down below. Right here is where we transfer assets. So press transfer. We want to send some assets from our funding account or spot account into our USDT margined futures account. So let's put some assets in, press confirm. Then you have some assets to trade with. So you should see that down here that we've got some equity in our account, which is 100. Equity is cash plus your P&L or minus your P&L if you're making a loss. So equity is cash plus profits and loss in positions. So that will change once we have a live position. So let's open a trade, cross margin, 2x leverage. So I will just open a market order to get the order done. How much do you want to go ahead and trade? Let's say that we have a $100 trade. We know we need to fund that with $50, as you can see here. So we can go and open a long. And down here, you can also open a take profit and stop loss at the exact same time that you're opening your position. So a stop loss means that if you're long, it means that you're buying. A stop loss would be selling out of your position at a specific price level. So technical analysis, up to you, but let's say that we want to potentially take a loss at 94,000. Right, so we're happy with the volatility coming down here, but if we start to really go south and actually go down. We just want to get out of the position because maybe we were wrong. So we can put that in, and that is basically a sell order at that lower price. It's a trigger order. It will trigger at that price and sell you out of the position because we're going long. That gets us out of a position at a loss, but it prevents further losses. You can see that if we actually did sell at that price, this would be the estimated P&L, $100 position, so 16% loss. You can put that in as you want. You can put this in after the fact as well if you don't want to do it right now. A take profit is of course on the upside for if you're going long. So if you want to put a take profit in of some amount, you can do that as well, whatever that may be. And you can see that's around 16% as well, right? So you don't have to put this in. If you take that off, you'll just put the long position in. You can add them later. So we are going to open an order for this amount, and we're going to go long. 2x leverage means we have to fund 50% of the position. So go long, confirm, and that's in. So now we have that position. Now market order trades immediately. You can see that we have this Bitcoin position. It tells us that we're long 2x leverage. This is the total. This is the price that we got in at. You can see the margin that we're using. That's the cash that we have tied up in the position. This is a running P&L, profit and loss. Realized P&L. I've opened a position. Now I can sell this down. I can sell the whole thing at once. That closes the position. But what if I sell 50% of the position now? Well, I will have realized 50% of the position. And so the realized P&L is what you made from the portion that you've closed. So if you make a big profit, sell half, that will be a realized profit instead of the running P&L right here. Estimated liquidation price would be around 50% below because we're margining 50%. Now we can see we can also close this if we want. We can do that, or we can add the TPSL here. So let's try and add TPSL. So click that icon. Now, if you want to add your take profit stop loss in after the fact, you can do it here. Put in your whatever it may be. You can see here, you can press confirm. That just puts in the stop loss order, which is associated with our open position. An important thing to consider when trading is the amount of cash or equity that you have in your account versus your positions. So I took a 2x leverage position. That means that I have tied up around 50% of the trade size. However, because I have other cash in my account, I have $100 of cash in my account, and I'm using cross margin. That means that the system is using all the cash that I have in my futures account to margin my positions. So even though I've tied up $50 of margin for a $100 position, if you look at your assets, I have $100 of equity because I have this $100 cash, which means that my estimated liquidation is basically zero, because I have $100 cash to fund this position here. So the system, when using cross margin, is going to take everything in your account and all of the dollar value of that to fund your positions. So I have tied up 2x margin here, but I have extra cash in my account. Now, what I could do in assets is take the cash out. You can see that the amount available to me is the amount that I haven't tied up in that position, which is this. If I took the extra cash out, the extra $50 out, my liquidation price would actually come up on the screen as a 50% loss because I'm margining 50% of the position. But because I'm using cross margin, I basically am not using any effective leverage at all, because my effective leverage is zero because my position size is $100 and I have $100 of cash. My effective leverage is zero. But if you took the cash out, then this would be it here. So if you're using cross margin, just think of the leverage that you're taking in terms of how much cash you want to tie up into positions so that you can't then use for other trading positions that you have. If you want to get out of the position or any part of it, you can do that. You can press close all here. That closes the whole entire thing. Or you can close a percentage of it by going up to the top right hand corner, press close, and then we can enter the amount that we want to close. It's known as closing because we're not buying and selling the asset. We're opening a position and we're closing a position. We have this open position now. So because we're long, that means to close it, we go short the same amount, essentially selling the buy that we had. So what we want to do is press close here, market order, choose the amount that you want to close, whatever that may be. Now, because we're long, we want to close our long, right? Close long. So we're actually selling, but it's known as close long because we're taking this position out. So close long. You can see here, you'll be essentially selling the exact same amount, press confirm. That will get out of the position, so now we have no position. We can take short trades as well, and there's two main ways that people do this. The first is using cash to short. That's known as a naked short, because you're just taking a short position on the price of the asset, and you're funding that with cash. The reason it's naked is because you have cash to fund. So let's say that we are taking a short position on the price here, and we actually benefit from the price going down, which means that if the price moves up, we lose, right? Because we're essentially selling. So if you're selling here, you want the price to move down where you make your profit. If the price moves up to any level, that means you have to buy back the asset to close out your position, which means you start making a loss. So it's essentially like selling. If you sell now and buy back higher, that's not good, and so you're making your losses there. This is known as naked because you don't have the asset itself. You're shorting and paying the difference with cash. So if you want to go ahead and do that, you can. So what you do is open market order here. You want to take a short position. So let's take another position of $100. We want to take a short position, confirm. This is essentially like selling the asset. So we've just sold the asset. So now in order to close the position, we have to buy the asset back. If the price rises, then we buy at a higher price than we sell, and we're going to lose money. We have our cash to fund that trade. If the price falls, then we sell high, buy low. And so that's obviously how we profit. So it's exactly the same, but it's known as a naked short because we're using cash to do this. You can close all here like this, close all, and then that gets out of the position. The other way people may fund their short trade is to use the asset itself. This is known as a hedged trade. So for that, we obviously have to go into coin margined futures. Coin margined, that's where we're using crypto asset collateral to back our trades. So let's say that I put $1,000 of Bitcoin in coin margined. Bitcoin, the dollar value of that is going to change over time, right? The reason that I would put Bitcoin in here and take a short position is if I think that the asset is going to fall in value, right? So if I own Bitcoin and it falls in value, I just have less value in the Bitcoin if I'm just holding the Bitcoin. However, what I can do is put some Bitcoin on here and use the dollar value of that to take a short position in the same asset, Bitcoin. That means as the Bitcoin falls in price, my asset is falling in price. However, if I take a short trade, that short trade will be gaining in the trade because I would have essentially sold, taken a short position, and as the price falls, the trade moves into a profit. That's known as hedged because you have the asset itself. So you're hedging some of the exposure of your asset by taking a short position as the price falls. You are making profits in the trade, which cancel out some of the losses in your Bitcoin. The reason people do that is because they don't want to sell the asset. Maybe they have a small position or part of their portfolio that they trade with. They think they're entering a bear market, so they're using the coin and trying to hedge some of that, make some profits trading. Of course, if you get the trade wrong, then you're giving up upside because your Bitcoin collateral is there. As the price moves up, the Bitcoin is going up in value. However, your short position is losing value, taking away from those profits. So that hedged position is some protection to the downside whilst giving up potential upside if it moves up. So that's how people would trade and hedge their positions as well. Like I said before in the video, if you're using coin margined to go long the same asset, things get extremely volatile. If the price moves down and your trading position loses, it's like exponentially lower prices and you get liquidated extremely quickly because your collateral value is losing whilst the position is losing. If you're long, then you make very big gains as well to the upside because your collateral rises in value and the position is rising in value. And when you trade in coin margined, your profits and losses are taken in the coin, not dollars. So let's say that you make a profit, you put Bitcoin on, you go long, you make a profit. The profit that you make will be put back into your account in the coin itself, so Bitcoin, rather than dollars. If you're using dollar margined, whatever your profits and losses are, they will come into your account as the cash, so USDT or USDC, whichever you're using to margin. I'll leave my beginner's guide for Blofin down in the description, and the bonus link for new users will be down there as well. I'm James, this is Managing G. Cheers for watching, and I'll see you in the next one.